The Construction Market Guide is designed to provide contractors and construction executives with timely data on the economic environment, materials prices, and the labor market so you can make informed decisions that increase profitability. The Architectural Billing Index is setting off alarm bells to me at these levels, and I want to talk about that. But first, some background. As you know, the Fed has been raising interest rates aggressively to try to get the inflation rate down, and their target is 2%. As you can see from this chart, they brought it all the way from 9.1% down to 3.2% as a rate of increase in prices on an annual basis. Now, that doesn't mean they want prices to go down. They really just want to bring the rate of increase down. But at the same time, we're seeing with construction materials, prices are in fact falling. Lumber down almost 20% over the last year, oil down 10% or so in just the last month. Now, the stock market is forward-looking, so it's celebrating because in the latest Fed meeting, Fed Chair Jerome Powell said that he thinks they're probably done raising interest rates, and it's likely that the next interest rate move will be to cut rates. See, raising interest rates is a lot like drinking shots of tequila because both have long and variable lags between when you do them and when they kick in. And we may be at that point where they've gone too far and need to start to aggressively cut rates. Certainly, the Architectural Billing Index is flashing warning signs that we may be. Again, we see that a rate below in the Architectural Billing Index, below 50, means a contraction in the sector as architectural firms obviously design projects before they're built. And so when we see significant declines over the last 3 months in inquiries as well as design contracts and actual billings, definitely a concern for construction. Now, as we look at construction sentiment, the backlog indicators, they're not really reflecting that yet. We see they've been pretty stable, down from where they were a year ago a bit, but still holding up okay. So we definitely want to keep our eye on that as we move forward. The unemployment rate is also low. I mean, the rate of wage increases that workers are seeing has dropped from about 7% back in March of last year down to about 3.9% today, and the odds are, or the direction is that it's shrinking. And the unemployment rate is still low. But if that goes up, that'll be definitely increase the odds of a recession because, of course, if people don't have a job, they don't spend money. So we're definitely keeping a close eye on that. But the economy has surprised us before. I mean, most everyone has been surprised at the resilience of the economy. So stay tuned as we see how things play out. Our advice for construction business owners is to use caution. We think that's warranted at this point. Increasing cash reserves is a good idea, and make sure you're getting a good return on your cash. And the 4 to 5% interest rate is about where yield should be on safe money. And if you're not getting that, please reach out to us. We're happy to help. Also, it's a good time in the slower months here to review your 401k. Make sure that employees are getting the education and information they need to plan for a successful retirement for themselves. Make sure you're doing that planning for yourself as well. And I'll say fees in the retirement plan space have come down pretty dramatically over the last 10 years or so. So if you haven't reviewed your plan in the last few years, now's a great time to do that. And we're happy to benchmark your plan, to compare, given your size, your head count of employees, the assets you have in the plan, what your fees should be for third-party administration, for financial advisory services, and for your investments in the platform. We're happy to review those things and see if there's benefits or adjustments we could make to improve your retirement plan's performance. So please reach out to us if you'd like to have that conversation. We're happy to chat. Thanks.